Welcome back to the part 2 of the chapter 10. So we already covered invested capital. Now we want to talk about earned capital. So this component of equity actually representing the net asset of the company that have been earned for the stockholders rather than invested by the stockholders. So we will also see that some of this earned capital is distributed back to the stockholder in the form of dividend. And thus, we will end up with a component of equity that representing the earned capital that has been retained in the company, commonly referred as a retained earning. So first of all, we wanted to describe retained earning and recording cash dividend. So earning returned. So returned earning, I remember in chapter 1 we kind of talk about it. I said returned is kind of like an adjective. It's talk about things like left in, right, left out. So what is the return means that earning retained in the corporation and not paid out to the dividend. And so then it equals that all the net income less all the dividends since the day one of a company begins its operation. And it usually have a normal credit balance. In other words, the balances in return earning equals all net income since the day begin of the company begin and minus all the dividends since the company begin. Let's see an example of return earning over a 4-year company. So year 1, this company had a loss, maybe because they are just starting working, right? Hence, there's no way dividend can distribute to anyone. Hence, that the balance in return earning gonna equals net income plus dividend is gonna minus $1,000. In year 2, they made $3,000. However, look at this, return earning is a permanent account. So therefore, it's accumulate all net income minus all dividend, right? So therefore, you made $3,000. So accumulating on top of that minus 1,000, you left with the $2,000 in return earning. On third year, you made $4,000, but before you retain them, you distributed $3,000. Hence, that it only left the $3,000 for year 3 earning minus the dividend. Hence, that the dividend, the return earning account is just gonna grow from $2,000 to $5,000 because you add $3,000 here, right? And year 4, you made $10,000, but you distributed $3,000 cash dividend. Hence, that you actually have a $7,000. So therefore, from last year's $5,000 in return earning plus $7,000, you're gonna get $12,000. So this step by step shows you that the balance of return earning equals all net income minus all dividend to date over the life of the company. In year 1, the company shows accumulated deficit. Okay, so some mistakes a student might think incorrectly is that return earning representing a cash balance set aside by the company. No, totally not, right? In fact, the size of return earning can differ greatly from balance in cash account. Facebook, as an example, Facebook reported 21.7 billion in return earning and only have 8.9 billion of cash. So then if we talk about the return earning, then we also need to look at the role of cash dividend, right? So cash dividend as a distribution by a corporation to its stockholder, investors pay very careful attention on cash dividend. Okay, a changing in quarterly or annually cash dividend can providing a very useful information about the future prospects of the company. Because, for instance, an increase in dividend often perceived as great news because the company tend to increase the dividend when company believe that in the future it will doing pretty well. That's why they declare more dividend. And also, not all companies pay dividends. For example, growth companies usually prefer to reinvest all the earnings rather than distributing to the investors. So then how does the investors make money if a company decides to never pay dividends? And so like Facebook, for example. So this investor, in order to make money, these investors need to hope their company's share price goes up, hence they can sell to make money. Because to sell the buy low and sell high. So let me show you guys what the Facebook say about their dividend policy. Very interesting. It says we have never declared or paid cash dividends on our capital stocks. We currently intended to retain any future earnings to finance the operation expansion of our business, and we do not expect to declare or pay any cash dividend in foreseeable future. As a result, you may only receive a return on your investment in our Class A common stocks, and if issued our Class C cash capital stocks, if the trading price of your share increases. So in other words, Facebook said that we will never declare a dividend. If we ever make any money, we will reinvest it back into the company to make it grow bigger. So therefore, if you ever expecting to making money by waiting for us to pay you dividend, then probably that's not the right thing, the right portfolio for you to have. But however, if you wanted to invest in our common stock, Class A common stocks, then you can expecting the price of our stock go up, then you can sell. Okay, so that's interesting. That's just an exception. So let's go back to talk about the people who are normal, which is usually people do declare dividends, right? So what kind of criteria and how do we declare dividends? So for companies that do pay dividends, the date of board director announces the next dividend to be paid is known as a declaration date. So in other words, declaration date is defined as on which board of directors declares the cash dividend to be paid. Once you declare, okay, it creates a binding legal obligation for company to declaring dividend, meaning that if you declare you're gonna pay dividend, you better pay. If you don't pay, that will be a part of a liability. And then record date. Record date is a specific date on which company will determine who are their investors and who receive how much. And the payment date is the date that they distribute in cash or checks to the stockholders. So let's look at. So then the question is, when should we record the transaction of dividend distribution? Of course, declaration date, right? Because declaration date is the date that they have you set up your duty to really pay for dividend. So let's look at this example. On March 15th, Canadian Falcon declares 25 cents per share of dividend on its 2,000 outstanding shares. So there's a declaration date is March 15th. So you will debit dividend for 2,000 shares multiple 25 cents, and you credit a liability account for the dividend payable for $500. The dividend declared by Canadian Falcon is paid on April 15, which is a payment day. We will debit the dividend liability and credit cash for $500. So, in other words, the dividend account is a temporary stockholder equity account that will be closed into return earning at the end of each period. Okay, so this dividend account, remember, is a temporary account. When we close dividends, what we do, we debit returned earning, and we credit dividend, right? Yeah. So that's what it means. Like this debit side dividend is gonna be used to reduce the returned earning for current period when you closing the dividend account. Remember, we talked about there's a several bucket, right? The revenue bucket, the expense bucket, and dividend bucket. they're all going to go to the return earning bucket. Remember that example? So revenue account, expense account, and dividend account. Revenue have a credit balance, expense have a debit balance, and dividend have a debit balance. Look at this debit balance. So when we want to dump all this three accounts into returned earning, we debit out revenue, we credit out expenses, and we credit out dividend. That's how we dump into the return earning. This is what I meant. So you establish dividend on March 15th. So by, let's say, December 31st, 2020, then you're going to dump this dividend account into return earnings debit side by debit return earning credit dividend. So that's why dividend account is a temporary stockholder equity account that is closed into return earning at the end of the period. Okay, so the key point here is that when it's a declaration date of the cash dividend, it will decrease the return earning and increase dividend payable. The payment day of the cash dividend, it will decrease the dividend payable and decrease in the cash. So the net effect then is a reduction of both return earning and cash account. Okay, so on which date would a company record a debit to dividend and credit to dividend payable? Date of declaration. That's the day that you set up your duty to pay, to really pay. Okay. So, and then next thing we want to learn is how to deal with the stock dividend and stock split. And if so, what's the difference between stock dividend and stock split? So stock, sometimes corporation distribute additional share of their own stocks to shareholder rather than cash. This is known as stock dividend or stock split. So stock dividend is additional share of a company's own stocks given to the stockholder as a dividend. And it's depending on the size of this stock distribution. If you own, say, 100 shares, right, of the stocks, and assuming you have a 10% of the stock dividend, then that means you will get 10 extra shares at the end of the year. That's called a small size stock dividend. So say if you get 100% of the stock dividend, that means you're going to have 200 shares after the declaration. So somebody calls this a stock split because you basically equivalent to 2-for-1 split if it's 100% stock dividend, right? Okay. So, and then so let's define stock split. Stock split means a large stock dividend that includes a reduction of par value and stated value per share. So if you do stock dividend, the par value, remember the legal value of the stock doesn't change, does not change. But if you do stock split, you got to make sure that you reduce the par value. If it's a 2-for-1, then that means the par value become half. If it's a 3-for-1, then that means the par value become 1/3. It depends on how you split it. Okay. So that's a bigger difference between stock split and stock dividend. And then, so let's give you an example. If you own 100 shares, assume that you get 10% stock dividend, then you have a 10 additional share. If you 20% stock dividend, you have a 20 additional share. And if you have 100 stock dividend, that means you're going to gain 100 additional share. So these two consider as a small dividend, stock dividend. And then 100 stock dividend, it can be considered a big dividend, large dividend. Or you can think, so for example, if you can think like a company as a pizza. For 100 stock dividend is like changing 8 slices of pizza into 16 slices and cut each slice in half. And you are no better off with a 16 slice pizza than original 8 slice. Whether it's cut in 8 large slices or 16 small slices, it's still the same size pizza, right? So whether a company is representing by 1 million shares outstanding with $40 each or 2 million shares worth $20 each, that is the same, that is still $40 million company. So when there's a large stock dividend, we can also call it a stock split. Okay, but there's a fundamental difference between the large dividend and the large stock dividend and stock split. I explained that because the stock split will reduce the par value of the stocks into half. However, the stock dividend is still a dividend, hence the par value don't change. Okay, let's look at split for 1 second. So stock split reduce the par value per share and increase the shares outstanding. No need to record a transaction. That's another biggest difference between stock dividend and the stock split. However, the larger stock dividend, it has to record a decrease in return earning and an increase in common stocks recorded at the par value. So if you say you give another 1,000 share of the stock dividend, you're going to use 1,000 multiple 1 cents, and then you credit in common stocks. And similarly to cash dividend, the stock dividend account is also a temporary stockholder equity account that is going to close into the return earning. The debit to the stock dividend to reduce the return earnings. So the stock dividend entry decrease one equity account, which is return earning account, and increasing another equity account, right? So you decrease equity on this side, and you increase equity on this side. Hence that there's no impact on total asset or total liability or total stockholder equity. There's no impact on them. So let's look at before 100% stock dividend versus after 100% dividend. So if you prefer the stocks to 30 par, they both stay the same. However, the common stocks before you have 100% of the stock dividend is only have a $10, but after you give 100% dividend, it become a $20 because your par value increased. You have an extra 100 share of common stock. Right now, here you have 1,000 share, and here you have 2,000 shares. Okay. And then additional paid in capital doesn't change because remember the dividend, a stock dividend doesn't change anything about the asset or liability or total equity. However, the return earning is what I want to say. It was before it's 29,500. Right now, it reduced the $10 because this stock dividend, which is the extra 1,000 shares, is coming from the return earning account. So it's reduced the return earning account, right? So in other words, so the common stock outstanding, of course, here you're gonna say it's gonna be 2,000 shares rather than 1,000 shares, right? And then the share price is gonna be reduced in half. Look at that. Before it was the 1,000 shares sold at $30 each, because you declared extra 100% of the stock dividend, the share price cut into half. So let's do a more concrete comparison between stock split and stock dividend. The total stock equity holding of both methods does not change at all, no matter it's a stock dividend or stock split. The common stocks for stock split does not change. There's no journal entry in terms of stock split, but stock dividend for the common stockholder does increase, right? Remember the 1,000 share multiple 0.01, right? So it has a journal entry of debit stock dividend and crediting common stock for that $10. Remember? Yeah. So therefore, common stock does increasing, right? And the return earning stock split don't change because no journal entry, nothing changes. But the stock dividend, the earnings equity, the return earnings is decreasing, right? So this one is going to decrease RE, return earning. This one going to increase common stock, right? Because this journal entry. And then par value per share, stock dividend, no change, but stock split dividing the half. Okay, this is very interesting. Okay, so small. Then what we do if it's a small stock dividend? First of all, we want to record it at a market value, not par value. Second, it does not change in total asset, total liability, or total stockholder equity. So in other words, any kind of stock dividend don't change in the total of the structure of the assets, liability, and equity. So any kind of stock dividend doesn't change in that. However, but what we want to know is that within this equity section, it's decreasing one equity account, return earning, increasing two other equity accounts, common stocks, and additional paid in. Why is that? Because with a small small stock dividend, you want to record at the market value. So when we have a market value, we know there's definitely the additional paid capital. So therefore, when we debit stock dividend, we want to record at a $30 per share instead of a 0.1, right? So that's $3,000, and we know for 1,000 shares, the common stock at par value is going to just be at $1. However, the additional paid-in capital is $2,999. So therefore, when you have a very small stock dividend, first of all, nothing changed between total asset, total liability, and total stockholder equity. But within stockholder equity, the distribution or categorical name between stock dividend, common stock, and the additional paid-in capital, they change because you will have a reduction of returned earning by debiting stock dividends and at the market value, and then also you will crediting the common stock, which is increasing common stocks, and also at the same time also you increasing additional paid capital. So the key point I wanted to emphasize here is that declaring stock dividend and stock split is like cutting pizza into smaller slices. Everyone has more shares, but each share is worth less than before. So a company has 1,000 shares of $20 par value outstanding and issue 2-for-1 splits. How many shares are outstanding? So of course 2,000, right? So that means the one share split into two. Hence that 1,000 share, you have 2,000 share now, right? Okay, so let's look at the reporting in part C. I just do one video. So part C is reporting stockholder equity. So how do we reporting now? So first of all, we wanted to prepare and analyzing stock equity section of the balance sheet, and then we're gonna introduce you another statement called the statement of stockholder equity. So let's say stockholder equity section of this company, which is called NVIDIA. It's a pretty new company, as we already learned that they do not, first of all, it's going to be part of the balance sheet and in the section of equity section. And then this company apparently does not have a preferred stocks, but they have a common stock and they have a legal par value. They issue common stock with par value for 868 shares. So it's almost $1. And then with those common stocks, then they traded on the market to have additional paid-in capital of $4,708. So therefore, the total paid-in capital, which is the part A of our lecture, is $4,709. And then we can see that the return earning for current period is actually $6,108. So that means the day one to current period, this company internally generated funding of $6,108. And interesting enough, they actually have a lot of treasury stock. They have 283 treasury stock, which worth $5,000.39. Okay, and then they are accumulating other kind of comprehensive loss, hence that the total stock holder equity $5,762. So what I want to say is that if you notice for NVIDIA, the balance in the return earnings is so large that it actually exceeds the total equity, right? $6,000 is much bigger than the paid-in capital. This is the external capital. And then this is the internal. Right, so $6,100 is much higher than $4,000. And then why is this happen? Usually, a lot of people have a much higher paid-in capital. Return earning is gonna gradually grow bigger. And then why is this happen like this? This is because NVIDIA has used a portion of cash to generating from the earning, the portion of cash to retire or buy back a very big chunk of the outstanding share. Hence that they have a big treasury stocks, right, for $5,000. And then hence that if this 5,039 is not buyback, it will park under this line, right? Because this is gonna be outstanding share outstanding. So NVIDIA has applied this strategy to such extent that the balance in the treasury stock representing the cost of share purchased by the company is actually exceeds the total paid-in capital. So majorly, this company is not owned by the outstanding people anymore, right? They only own outstanding people externally only own $4,000 of shares, but actually NVIDIA actually holding its own company's stocks for $5,000, representing total cost of share originally issued. So basically, this company uses a strategy of buyback, actually reshifting the equity structure from external funding to internal funding, right? And then that means that the control rights of this company is actually reducing because a lot of treasury stocks. Okay, so and then let's look at another company called the Canadian Falcons balance sheet. Then this company look a little bit like normal, like they have a preferred stocks for $30,000 issued above the par, and then also they have a common stocks at 1 cent par value, and they issued 1 million shares. They have a 1 million share for authorized, and they issued 2,000 shares, so that's gonna be $20 at a par value. And the additional paid-in capital between adding the preferred paid-in capital and common actual paid-in capital, they have a $40,490. So therefore, the total paid-in capital, which is external funding, investment, right? So in external funding is 70,510, and then the internal financing, which is their own companies doing business, is actually from the day one is $29,490. They have a zero treasury stocks. They didn't buy anything back from the market, and their total equity is 100,000. So then the next thing we wanted to introduce is actually statement of the stockholder equity. But before that, I want to say that so the stockholder equity section of balance sheet is like one just examined in NVIDIA and shows that balance of each equity account, right? So this is the preferred stock account, common stock account, additional paid-in capital account, and return earning account, and treasury stock account, and total stock equity account. This is at a point of time, meaning that you took a picture of this company, and it stays that way, right? However, when you look at the stockholder equity, it's actually a different way. It's more like a net income or income statement, because it describes what was before and what is now. Okay, so what is now. So it's almost like describing you a story of what happened in 2021. See, in January 1st, they have a zero preferred stock, but during the 2021, they issued a preferred stock of $30,000. For common stocks, in January 1st, the company haven't existed yet, but during 2021, they issued they issued a common stock worth $10, right? And then they also declared 100% stock dividend for $10. And then the additional paid-in capital associated with the common stock during this year, and the additional paid-in capital associated with the preferred stocks is $10,000, and then they resell the treasury stock for $500. So that's the additional paid-in capital, right? And at the same time, they also distributing cash dividends for $500, and at the same time, they also have a 100% stock dividend again. They issued $10 worth of common stocks, right? And then also they sell. Remember, this is one journal entry. Remember, debit stock dividend and credit common stock. Yeah, so this two number is the one journal entry, and then this is under return earnings because remember, stock dividend is a temporary account. It will be closed into the return earning as a negative reduction of return earning in the year end. So this all it's meant, this two number is this firm declared 100% and a stock dividend. At the same time, they made $30,000, right? So that means that $30,000 is going to be distributing in form of $500 of cash dividend and $10 of common stock dividend. And then they also issued preferred stocks, right? They also repurchased treasury stock, and they resell the treasury stocks as well. So that gives us. And then after you adding the horizontal line all together, you find that they repurchase the stock. So for example, they have a total common stock for $30,000. They issue preferred stock for $40,000. They repurchase the common stock for $3,000 and resell treasury stock for $3,500. And they actually have a cash declaration of dividend for $500, and then their net income is $3,000. Hence, that after the whole year, they have $100,000 of equity, right? Stockholder equity. So all we want to take away from this is the stockholder equity section of the balance sheet presenting the balance of each equity account at the end of period of time, at a point in time. It's like you take a picture of someone, and then they stay that way for that picture. So, and then the statement of the stockholder equity shows that changing in each equity account over the time. So let's take a concept check. So how does the stockholders equity section of balance sheet differ from the statement of stockholder equity? So the stockholder equity section shows the balances at the point in time, and the statement of stockholder equity shows active over time. Yes. Okay, let's look at the objective 8. Once we kind of broadly learn the stock equity portion of the balance sheet or stockholder equity, we know there's a external funding and there's the internal funding and there's a dividend section. So we wanted to understanding how to evaluate a company's performance using information on stockholder equity section. Okay. So first of all, we can measure return on equity. This is a ratio that measures ability of a company management to generating the earning from the resource that owner provide. Earnings are a key to a company's long-run survivals, right? However, we needed to evaluate earnings in comparison to the size of the investment. For instance, the earning of $500,000 may be quite large for some small company, but it would be rather disappointing outcome for a major corporation for example, IBM. A useful summary measure way of earning that it considers relative size of business investment is using return on equity ratio. So return on equity equals the net income dividing average stockholder equity. Okay, and then dividend yields is actually measure how much a company pays out the dividend relative to its share price. So it equals dividend per share dividing stock price. So let's look at the financial data for Facebook versus IBM. So they have a net sale, net income, total liability, stockholder equity from beginning and ending. So if we're adding these two numbers up, dividing 2, we got the average of stockholder equity. Okay, and then stockholding price and ending for two company and dividend per share, right? So Facebook declares 0 dividend as its dividend policy, and the IBM declared $5.50, and the average share outstanding is 2,863, and the IBM's 2,863 million, and the IBM is 955 million. So in order to calculating return on equity, we're using net income dividing average stockholder equity. We got the Facebook is 19.8 and IBM is 72.4. So that means Facebook have a return on equity of 19.8% compared to 17.4% for IBM. At first, you might think this means that Facebook is less profitable, and in terms of return on equity, that's true. However, a key reason for the difference in return on equity is that Facebook relies greatly to a greater extent on the equity financing, while IBM relying on debt financing. The ratio of debt to equity for Facebook is 9. So if you compare debt to equity, remember that ratio, how the capital structure ratio, how much funding, external funding come from who. So debt to equity ratio for Facebook is actually only 9.7%, and then for IBM is actually debt to equity ratio is 538%. That means debt is 5 times more than equity. So in other words, Facebook is relying on the equity financing, and IBM relying on debt financing. So while shareholder of IBM earns more dollar, right? So $1 of investment in IBM, you make 72 cents, but $1 of investment in Facebook, you actually only make 19 cents. So while shareholder of IBM earn more per dollar per equity, a higher portion of those earnings actually devoted to pay the debts. Okay, and Facebook actually have a much higher return on total assets. Okay, so let's look at the dividend yield for Facebook. So we know dividend yield is actually using dividend per share dividing stock price. So Facebook declared 0 dividend and IBM declared $5.50. So that means that's representing saying that small growth company tend not to. Okay, Facebook is special because at day one it decided to not declare dividend, but usually small growth companies tend not to pay dividend, while larger company, older company, the more mature company, they probably do. Facebook does not pay dividends, so its dividend yield is 0%. IBM pay relative very high dividend for 3.3. Shareholder of the Facebook and the total stock return equals to the change of stock price for the year, and shareholder of IBM earns the total stock return equals to changing the stock price for the year plus dividend yield. So if you wanted to calculating return of Facebook people, Facebook shareholder, right? So return is the stock return. You just need to use the last year's stock price, this year's price of this year minus price of last year dividing price of last year. T minus 1 means last year. T means this year. But the return, stock return of IBM is actually equals price of this year minus price of last year dividing price of last year, and then remember plus dividend. Okay, that's the return, stock return of the which is a 3.3 here, right? So dividend yield, right? Okay. And then another very important thing is earning per share ratio, which measures the net income earned per share of the common stocks. Is equals to net income minus the dividend on preferred stocks dividing average share of common stock outstanding. Earning per share is very useful in comparing earning performance of the same company over time, but it's not useful for comparing earning performance for one company with another because wide difference in the number of shares outstanding among the firm. For example, if a company have 1 million shares versus a company have 1,000 shares, you will always find that the people who have 1,000 shares outstanding are much more profitable or better performance than the 1 million share. But that's actually not the case. How many shares outstanding is not relevant to how well you do for this how the company is doing. And another thing that we wanted to talk about is the price earning ratio. It's indicating how stock is trading relative to current earnings. It equals the stock price dividing earning per share. A high price earning ratio indicates that market has a high hopes for the company stocks and has beat up the price. In other words, it means that this price earning ratio indicating how the stock is traded relevant to its current earning. So you earn, say, per $1, you earn 30 cents, right? So 0.3. And then the stock is traded at $3. So that means people believe you, the market investors believe that you have very high earning potential. Otherwise, why do they trade a stock that only make 30 cents out of one share at $3 because they believe this company can make a lot of money in the future, hence that the trading price is much higher. So sometimes the price earning ratio commonly are in range of 15 to 20, right? A high price earning ratio indicate that the market think highly about the potential of the company or the hopes for company stocks goes up. And the growth stocks are the stocks of the future earning investors expect to be higher. So if a company you feel like have a high growth potential, then their PE ratio is going to be really high. Because the stock price are high in relation to the current earning because the investor expecting a better return in the future. However, the value stocks, sometimes we call that, it means the PE ratio is pretty low because it could be because the low price in relation to earnings may be justified because of poor future perspective, or it's because this stock is undervalued, okay, by the market. And let's look at the Facebook's PE ratio is actually 32.2, and the IBM is 13.4. That's exactly what we're expecting because Facebook is much like growth firm, and the people have a high expectation for its future. Hence, that people willing to trade in much higher price conditioned on or regardless of earning per share is not as high as what they are traded for. Okay, so the key point here is that return on equity measures ability to generate earnings from owners' investments, not the debt holders' investments. It is calculated as a net income dividing average stockholder equity. And the dividend yields actually measures how much a company pay out to individuals in relation to the stock price. And the earnings per share measures net income per share of the common stock. And we say that it's only useful if you're comparing companies with itself. You cannot use this one to comparing with other companies' earnings per share because it's not comparable. And then price earning ratio is indicating how the stock is trading relative to the current earning. If a high potential or the investors or market believe this is a high growth firm, usually their PE ratio is relatively high. So PE ratio representing typical more than 100, no, typical between 15 to 20. And the B equals the stock price divided net income, no, it's actually it's all the way around. And C typically is less than 1, no, and indicating how a stock is trading relative to its current earning, yes. This is not divided by earning, right? It's divided by EPS, stock price, dividing EPS. Okay, so we basically went through the chapter 10. I believe chapter 10 is not a very difficult chapter. We talk about invested capital, which means, and we also talk about earned capital, right? And the invested capital, we talk about common stocks, right? We say there's a par value versus paid-in capital. And we also said that there is going to be preferred stock. And what's difference between preferred stock? We said it's in between debt holder and versus common stockholders, right? And we talk about they have a par value and also they have a paid-in capital, right? And we say if you declared the dividend and you didn't really pay, how we're gonna deal with it. And the third thing is we talk about the treasury stocks. Is actually a company buy back the stocks at market price. And how do we record a journal entry? And then we also talk about the resell the treasury stocks. And how do we do it, right? And then in terms of earned capital, we talk about the return earning, right? So what is return earning? It's the internal funding resources, right? We said it's equals all net income minus all dividend. The day one, right? And then we say that in order to calculating net income and dividend, we have a cash dividend, and we have stock dividend. And then we say that there's a declaration day dividend and there's payment day, right? How to do journal entry. And declaration day is the day that we record a liability. And then when we debit cash dividend, is actually a credit dividend payable. This is actually reduction of return earning account at the end of period. So does a stock dividend, right? Stock dividend, we say there's difference between 100% dividend and 2-for-1 dividend split, stock split, right? So the difference between the stock dividend and stock split is the stock split reduce par value and the number of shares outstanding, but does not have a journal entry. But the stock dividend is almost working exactly like cash dividend, but we record at par value. But if there is a small stock dividend will record at the market value, right? So, and this is, and both all of this one and this one debit the dividend, stock dividend is reducing the return earning. And then the last part of it, we talk about the return on equity, the ratio analysis, and the dividend yield. Yeah, and we talk about earning per share, and then we talk about a P/E ratio, right? So I wanted to say that this chapter, in terms of journal entry, is not difficult at all. In terms of concept, I do not think it's difficult either. What I think might be challenging is new concept, right? Those new things that we might not be familiar with. It's not a difficult, okay? It's not a difficult concept, but it's a lot of small concepts and new concepts that you might need to digest. So therefore, my suggestion is reading the chapter to learn smart and listen to this video. It might help. And in other words, to tackle this chapter, you might need to use the memorization more than logical and or deductive ability. So therefore, this chapter I consider is an easy chapter. Okay. So, and I thank you for your attention, and I will see you guys next chapter.